You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Steve Odland from the Conference Board and the host of this podcast series. And in today's conversation, we're going to discuss the latest situation in China and specifically what companies who are trying to do business there are facing today. Joining me is David Hoffman, the Senior Advisor and the China Center Leader for the Conference Board. David, welcome.
It's great to be here, Steve.
So, David, you've been in and around China for decades, and you lead our China Center in Beijing. And just for our listeners, if anyone wants to hear more about the China Center and membership and that and all of that stuff, just contact David directly via email. But David, you've been developing insights about China and how businesses can do, particularly Western businesses can do business in China. Talk to us about the state of play in China today versus where it's been in the past.
Yeah, thank you, Steve. In fact, I just returned from China last night. I've been there the last 3 weeks in both Beijing and Shanghai. And, for the listeners, it may help to recount the China Center setup in 2006. That's when a group of 10 of our trustees got together and decided that China was big, important, mysterious, risky, innovative, inscrutable, risky, all these things, and that the Conference Board should have a presence there on the ground to study the economy, to study the business environment, and inform them with the facts they needed to succeed. So we've always had an orientation of helping foreign companies, our members, understand the business environment there. And today, the business environment is complex. On one hand, you've got a slowing growth trajectory. China's going through a structural shift in its growth model, relying on very heavy investment and now trying to transition more to a knowledge-based, services-based, and consumption-based economic model, and that's not easy. You've got the rise of competition, Chinese competition, which have really improved their capabilities along design and quality dimensions. And we can talk more about Chinese competition and what it means, because we think it means big things, both in China and globally. You've also got a policy agenda that's sort of trending in an unmarketized way. And what I mean by that is there's more of a heavy hand on planning and industrial plans than there is on market forces. And our Western businesses, American businesses, our members are very market driven. So when they have to kind of contend with state influences, it can make things difficult. And of course, you've got the geopolitical issues. Those are sort of the downward pressures. On the upside, you've got a supply base in China that is just astonishingly broad and diverse and capable, highly innovative, where innovations cycles from sort of rapid prototyping to mock-ups and finished products are just unbelievably fast and competitive. You've also got, even though the policy environment is, as I mentioned, unfavorable in a way, insofar as it's not really oriented towards reform and marketization, it is very stable. And I say that, with a grin, because I would argue that probably China and Singapore are maybe the two countries in the world where the policy environments are stable. And you've said many times before, Steve, that what businesses really like is a stable environment. Even if the environment is less favorable than they like, stability is something they can manage. So you've got a big market, a slowing market, an innovative market, an increasingly competitive market, and external issues to deal with as well. But I would argue that China remains just as essential as ever, even more so, not just as a big market that our members need to support their scale and global competitiveness, but increasingly as an innovative base.
Yeah, and when you think about doing business in China, there's China for China, and then there's doing business in China really as part of a supply chain to supply businesses outside of China. You just talked about primarily the situation for businesses doing business in China. Talk a little bit about the opposite. What's the supply chain environment like in order to supply businesses outside of China?
Well, the supply chain is incredibly competitive, and you really need to appreciate the sort of end-to-end ecosystem components of the supply chain across almost every category, Steve, and all supported by very modern, very large-scale infrastructure. So China's competitiveness as a manufacturing base is not diminishing. And secondly, they are not abandoning the lower end segments of the value chain, of the production chain, even as they move overseas. And this is unusual because Western companies, when we began to produce in China, we often engaged with suppliers on a subcontract basis. China is not doing that. They're actually replicating their supply chains overseas. So you've got kind of end-to-end control. And that poses a real challenge from a geopolitical competition standpoint. But from a producer standpoint, if you are actually producing in China, the products are globally competitive. And you can see this in China's export numbers, which have been unfathomably strong during COVID and since COVID, and in fact, so strong that China accrued a 1.2 trillion US dollar export surplus or trade surplus last year. And if anything, China's export competitiveness, so if you say our members go there and buy stuff or procure stuff, it's very, very competitive, but it's becoming a big problem in terms of balance of trade arrangements around the world. And the US government has raised barriers to Chinese exports. Europe has imposed some and is considering more. And we expect trade defense measures to rise around the world because they just can't handle these imbalances. So back to your question, it's a great market to procure and produce and export from, but it's so great at it that it's running these trade surpluses that are unsustainable. And, something's got to give. We don't know when, but soon, I would reckon.
Now, there are geopolitical tensions, and we're going to talk about that in a minute. But how is it? You've been there. You've just spent 3 weeks there, but you're there every month. How is it for Westerners in China today? I mean, initially, what it was, 50, 60 years ago, it was closed. Then it kind of opened and it was a little tense. And gradually it warmed. And then it was kind of like very friendly. It was like anywhere else in the world, but it seems to have chilled again. So are Westerners welcome in China to do business, or is it uncomfortable?
No, absolutely not. It's actually very comfortable, very friendly, very welcoming, probably a lot more efficient than the last time you've been there, Steve. Things have gotten really smooth and easy, whether it's, booking a car or getting in from the airport. Everything is smooth and easy. But the people are very friendly, and the environment is very enjoyable. Air quality has improved. All sorts of things are net positive. One thing I would say, though, is that since COVID, when a lot of expatriates left China due to various issues like they did around the world, there's a lot fewer Westerners there now. It feels a lot like it did to me when I first went there as a young expert in a joint venture graduate school in 1985. And there are fewer. And I would say China is kind of de-Westernizing. It used to be you could find lots of Western restaurants and Western pubs and things like that. There are still some there, but there are fewer. And the de-Westernization is on the one hand sort of offset by a real revival or burgeoning Chinese cultural sector. So there's a lot to do and it's very interesting, but it's changing, it's changing. And it could be that we see a influx of expats once again, and we see kind of the Western culture things reemerge in China. I don't think it has anything to do with anti-Westernism. It's just that there are fewer Westerners there. So restaurateurs and hospitality venues aren't catering as much to, the Western taste as they once did. But top line, very friendly, very accessible, and extremely interesting.
And of course, you've got the geopolitical overlay to all of this, which does create some tension between the West and China doing business there. Even though what you've said is that the environment is friendly, there are the tensions there are trade tensions, as you said, between China and the West, but there are also tensions around, military dominance, who's going to control the South China Sea, and the situation in Taiwan. Just talk about that overlay. We're not political at the conference board, so we don't get into that element of it. But just in the context of doing business there, how do all of these tensions play?
Yeah, so the tensions raise a lot of risks and uncertainty at kind of a global level. And we've been doing a lot of work with members to help them understand and contextualize and plan for these risks. We have a couple different models that we've developed, a gray swan planning tool to add nuance to planning, a scenario planning exercise, and what we call a bottoms up or impacts-based approach to geopolitical risk management. So there are ways to manage these risks, but I wouldn't say our members think about these day to day at a business level. They're really focused on developing their China business. And in this kind of bipolar or polarizing or multipolarizing world that we now live in, fraught with geopolitical risk, which looks like, my assumption would be that this is going to be the state of the world for some time to come. The playbook is really that companies should overinvest in resilience and localize operations to the deepest level possible in each country or region they play in, so as to insulate themselves from external geopolitical risks. And that's what we refer to when we say China for China. And our members, so any company, any large Western company, European, American, or Asian company that's committed to China and the China market, because it's important to them for various reasons, has now moved down a China for China track that sees them becoming more and more localized. China is becoming a more and more divergent market. Its IT stack is almost entirely different from what we use in America and Europe. And companies are needing to address that changing environment. I think the best way to think of it is, what companies have done in Japan. I think you've worked in Japan before. You know how different the business environment is. And, any American company that has a large presence in Japan, their Japan operation will look very different than their home country operation. And that's how China is becoming. So geopolitical risks are real. Companies are doing the best they can to plan for downsides if they happen. And in the meantime, they're trying to ring fence and build resilience around their China businesses by making them less connected to, global influences, either supply chains or other things, so that the businesses are protected.
We're talking about the business environment today for Westerners in China. We're going to take a short break. We'll be right back.
What does the future of work mean for your employees? How will your company navigate the future of AI? Will there be a global recession? At the conference board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the conference board provides your team with an assortment of knowledge from economics, marketing and communications, governance and sustainability, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspectives. I'm your host, Steve Odland from the Conference Board, and I'm joined today by David Hoffman, who is the Senior Advisor and the leader of the Conference Board's China Center in Beijing. So, David, we were talking about geopolitics and trade largely, before the break. Let's talk about what's happening in China. You mentioned it in your introductory comments, but growth, Chinese growth, GDP, consumption, all of that is slowing. You've said that. And, we've talked for several years about the real estate market and how that has impacted it. That's not intuitive to people. How does the slowing nature of how does the slowing growth in GDP and the real estate environment impact doing business in China?
Well, real estate still has farther to go down in China. It peaked in 2021. Prices are down about 40% off their peak, and I reckon it can still go down further. That has hit consumer pocketbooks hard in China because in China, households put very significant down payments down on their properties, much more so than we do here in the US. And that means that's good for the banks, but it does mean that Chinese households bear the capital risk for the Chinese real estate sector, and that's a problem. So a declining market, the decline of real estate as an investment asset that was appreciating strongly. All of this drags on consumption, but more importantly, Steve, it drags on investment. So China has been an investment-driven economy for some 45 years. Has had the longest-running investment-led growth cycle in contemporary history. The closest equivalent here was South Korea, I believe, at 28 years. And usually after a long period of time of an investment cycle, the returns on investment become too low, or the investment becomes so inefficient that it's costing more to invest in it than you're getting back to the aggregate economy, that there's an adjustment. And you begin to see investment drop, and real estate investment upstream by developers in new projects has really fallen off a cliff. And that has put a huge hole in Chinese aggregate investment. They're trying to fill it with manufacturing and infrastructure, but the hole is too big. And that is what is bringing growth down. So that's kind of how the two relate. But on the consumption side, China has tremendous potential to further develop its consumer markets. They need to undertake structural reforms in order to do this. The net is that Chinese households in aggregate don't have enough money to spend. So it's not impoverished. We're not talking about a poor society, but the average Chinese household has very little discretionary income to spend on consumer products. It does have a large cohort of wealthy families and wealthy individuals, but they're, at best 9 to 12% of the total population. That's still huge. We're talking 200 million wealthy people there, but at the aggregate level, the large bulk of Chinese people, aren't poor, but they also don't have pocketbooks that extend much beyond basic lifestyle needs. So reforms are required there that would lift income through, topping up pensions and also, more progressive tax schemes and other things. And China has been unwilling so far to do this. And that's kind of a separate topic. We could go down a real rabbit hole there, but yeah.
So just a couple of follow-ups. This whole notion of real estate, is very complex. You did a really nice job explaining it, but there's residential real estate and there's commercial real estate. Both of them are underwater. But your point about the down payment is really important because in the U.S. if you put down 15%, and then a lot of times that's insured. It's not that much money that you put down. But when you're putting down 30%, the first 30% decline is your money, is the consumer or the buyer's money, and that's what's happening. So they feel poor, number one, and number two, they really can't move because they're underwater on their homes, and that's the home side. The commercial side is the same thing. They way overbuilt and way overinvested. Now you've got buildings that are just empty, and so that's all stranded cash. So everything's kind of seized up here a little bit. And so it's almost a miracle that their GDP is still projected to grow at 4.5% versus 5%. I mean, you would think, given what you've described, there would be, a 300-400 basis point hit, but it's 50, it's 50 basis points.
Well, China has so they have the ability on what we would call a administrative level to just kind of suspend these problems. So in the US, if a sector like real estate collapses the way China has, it would begin to transmit to other institutions or sectors of the economy that had linkage to them. The Chinese authorities can kind of go in there and sort of suspend everything. So they don't experience Lehman moments per se as Western economies do. And that means that the nature of the crisis is not sort of sudden seizure correction and then a period of pain, a recession, and then a recovery. Instead, it manifests in stagnation, slow stagnation. So that's what you feel there. And again, the Chinese numbers, what they're projecting to do, with net exports as strong as they are, toggling infrastructure, for most of our companies, our members, the growth rate doesn't feel anywhere near 5% to them. But that's because they're probably not touching the sectors that are growing at 5%. So we need consumer markets growing at 5%, and then our members feel it. But if upstream infrastructure to build climate defense systems in Northwest China is where they're spending the money to drive investment, very few Western companies are going to touch that GDP. Do you see what I mean?
Yeah, really, really important points. Now, the trade issues are, in the headlines every single day, and the tariffs on Chinese goods have floated all over the place for reasons we won't go into, but that's been the case from Europe and from North America. And so you've seen a lot of different ways of dealing with that. People have tried to move their supply chains, but also people are still manufacturing in China and then running it through Vietnam or other, nearby countries, and thereby, avoiding the tariffs. Talk about that whole strategy and how it affects doing business in China.
Well, a lot of our members, a lot of Western companies are also enjoying the benefits of China as an innovation and production and export base. So when we say diverting through Vietnam, that is happening, or that happened. It may still be happening. We are tracking that, but I don't have the latest figures in front of me. But I would say what's actually underneath that is not so much that stuff is being produced in China and then run through Vietnam and relabeled and put on a different boat and transiting. Instead, Chinese suppliers are moving to Vietnam and setting up factories. And they're often bringing their Western clientele with them. And that's where we see the real development. And what that means, Steve, is this will bring Chinese competition to a theater near you very soon.
And this is all playing out, on a global stage as people
Absolutely.
and trying to deal with. But there's no more important product that's being produced and shipped around here than advanced microchips. And so you see that even the Taiwanese companies who are TMC is the primary, opening up factories in China as well. So you've got to talk about the whole microchips scene as well.
Well, yeah, I mean they're doing China for China as well. On the advanced semiconductor side, I wouldn't say anybody, TSMC or any of the top US or Japanese or Korean or other firms have ever put their top stuff in China. And the reason they haven't is because, intellectual property protection safeguards still aren't there. And specifically, the penalties for IP infringement are just too low to be credible. So one of the reasons, why, these supply chains didn't ever move to China was not because the business case wasn't there. It was because the institutional safeguards weren't. Now we've got the geopolitical influences above it all. And so that has, put a damper on that change. But yeah, the semiconductor, China is dependent on mainland China is as dependent on Taiwan's semiconductor supply chain as we are, as is the rest of the world. I often liken it to Dune. You've seen the movie or read the book, but it's like Arrakis, and semiconductors of Taiwan are like spice in a way, and the silicon shield. Concept that they invented 30 years ago or conceptualized as a means to preserve their geopolitical space. I guess you would say it's working, but it is a complex and risky issue.
So then wrapping up in the final couple minutes that we have, you taking all of that in, what's your advice for multinationals or any company that's trying to do business or develop business or grow their business in China?
Yeah, I mean, the main thing I would say, and we didn't really get to it much today, is that Chinese competitors in manufactured products are really, really competitive. And it's not so much overcapacity based, so there's too much capacity, that's why the prices are low. Actually, Chinese firms for my entire career there have always competed along dimensions of price. It's what you experience when you go to markets there, and you haggle with sellers. It's a price kind of based, merchant culture. What's changed is that Chinese design and quality has risen to global standards. And they brought that price competition now to the level of advanced products. And it really poses, if you remember Clay Christensen's famous book in the 80s, The Innovator's Dilemma, it is bringing an innovator's dilemma to so many categories where you either confront Chinese competition by lowering your price, or you see your cash cows eaten away where you have to retreat into ever smaller niches, or you compete with them head on through innovation and faster market operations. But it really requires a fundamental rethink of how we do business, because they focus on scale and unit cost advantage. We tend to focus on profit maximization.
They also have still the labor arbitrage advantage.
Yeah, they've got that too. But let me give you an example. I was in San Diego, I don't know, a month ago, and there's a mall there, a very nice mall in La Jolla called University Town Center. I walked by a shop, and it's a Chinese brand called Dreamy, and Dreamy makes consumer home appliances and white goods. I think of it like a Dyson. So hair dryers, fans, and they're beautifully designed. They're, gosh, I don't even know, like 1/5 the price. Their quality is very good. But not only this, Steve, they had like 3 Chinese salespeople working the store, and they were out in the middle of the walkway, kind of handing out brochures and welcoming people in a very kind of China style salesmanship approach. And I thought, gosh, and it's appealing. It was bringing people into the store. And this is it was very surprising for me to see a dreamy shop in San Diego already. But this is something we all need to prepare for, and this is what our China Center is really focused on all of this year, is helping our members understand how Chinese firms compete and how we can compete against them and win. And taking into account the upstream parts where they have state support and labor arbitrage and other things, we also need to deal with that aspect as well. And it's an important topic, and we're working hard to try to shine a light on it.
So what I hear you saying is that China has, you didn't say it in these words, but they pretty much caught up here. Their quality is great, their productivity is great. They're dealing with their internal economic issues, which won't be resolved soon, and it's a drag on growth, but it's still a viable, attractive market to do business in. It's still a good place to do business for export, because a lot of the advantages still are there. The geopolitical overlay is there, but that's just part of what's going on around the world, and something that doesn't seem to intrude in day-to-day business. And then they're approaching higher levels of innovation and quality, which has never been part of the mix before. And so watch out, rest of the world, when price, quality, function really delivers products and services that are truly competitive and maybe more attractive than Western goods. Did I wrap that up okay?
I think you did great. I mean, again, I'm not trying to sugarcoat it. The China market is big and stable, but price competition is intense. So it's growth is under pressure, margins are under even more. Geopolitical issues are difficult, but I would argue manageable. And on the supply chain side, China offers a sandbox, a gymnasium. One of our colleagues at the China Center likes to call it a gymnasium. You go to work out there because that's where, if you get fit in China, you're going to be competitive globally. So but getting fit is not easy. So I'm not sort of saying like it's all sugar candy there. No, it's really, really hard work. You're going to have to bench press triple your own weight to succeed.
All right, we'll leave it there. David Hoffman, head of the Conference Sports China Center in Beijing. Thanks for being with us today.
Thanks so much, Steve.
Thanks to all of you for listening in to C-Suite Perspectives. I'm Steve Odland, and this series has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.